Welcome to The Explainer. Today, we are taking a sledgehammer to a massive misconception in the financial world. For years, people have looked at environmental, social, and governance metrics, ESG, as just kind of soft PR topics. But listen, if you're analyzing a commercial bank, these supposedly soft metrics actually reveal the very hard financial realities of the institution. So we're going to look at the 6 core sustainability topics that every commercial bank absolutely must disclose. And by the end of this, you'll see exactly why these metrics are just absolutely crucial for assessing true risk and future cash flows.
Now, our entire analytical framework today comes straight from the SASB standards, specifically their commercial banking guidelines. And it's important to know this standard, which is now part of the IFRS Foundation, is definitely not just a suggestion. It's a globally recognized, incredibly rigorous framework designed to show investors exactly what sustainability-related risks could reasonably be expected to affect a bank's cash flows, its access to finance, or its cost of capital.
Okay, let's dive right into this. Here's our agenda for today. 1. Unseen risks in banking. 2. Securing trust and operations. 3. The future of lending. 4. Confronting climate risk. 5. Preventing systemic collapse. And finally, 6. The investor's bottom line. We're going to explore these 6 critical topics using a framework I like to call the ripple effect. Basically, we'll start at the very center, the bank's internal operations and digital defenses, and then we'll slowly zoom out, looking at how the bank interacts with its clients, how it impacts the physical environment, and ultimately, how it ties into the stability of the entire global economy.
Section 1. Unseen risks in banking. Beyond the balance sheet. To really understand why this ripple effect is so vital, we first have to recognize a fundamental shift in banking. You see, a traditional balance sheet is great at showing you what a bank owns and what it owes today, but it completely fails to show you a bank's vulnerabilities to modern, evolving threats. If you're only looking at the balance sheet, you are literally flying blind to the risks that can wipe out a bank's value tomorrow. And that is exactly why these specific SASB disclosures exist. Section 2. Securing Trust and Operations, the Digital and Ethical Vault. Let's start with the innermost circle of a ripple effect. I want you to think of a commercial bank as a massive vault. But today, that vault isn't just holding physical gold or stacks of cash, it's holding vast amounts of incredibly sensitive digital data, and it's operating on a foundation of strict legal ethics. If either the digital or the ethical walls of this vault crack, the whole foundation crumbles.
And that brings us right to the first of our big 6, data security. By definition, a data security risk involves unauthorized access, destruction, or denial of service affecting an information system. For an investor looking at a bank's cash flow, this is not just an IT problem, it is a massive financial liability. The SASB standard actually requires banks to disclose the number of data breaches, the percentage that are personal data breaches, and the number of account holders affected. Why? Because failing to safeguard customer data destroys consumer confidence and vaporizes revenue overnight. If a bank can't protect its data from emerging cyber threats, it simply cannot protect shareholder value.
The second topic in our inner circle is business ethics. Banks operate in one of the most highly regulated environments on Earth. The standard mandates that banks disclose the total amount of monetary losses resulting from legal proceedings tied to specific behaviors. We're talking fraud, insider trading, antitrust practices, anti-competitive behavior, and market manipulation. These are definitely not just slaps on the wrist. In the financial sector, a lapse in business ethics leads to devastating legal proceedings, massive fines, and really severe reputational damage.
And this brilliantly illustrates the real financial equation at play here. On one hand, we have the upfront cost of compliance, things like robust whistleblower policies, internal compliance programs, and staff training. On the other hand, the cost of failure. Banks that invest heavily in compliance build trust and protect their bottom line. In fact, the SASB standard specifically requires a description of whistleblower policies and procedures because an effective internal reporting system is literally the cheapest and best defense against those catastrophic monetary losses from ethical failures.
Section 3. The future of lending, clients, and credit. Let's see how this builds as we step out into the second ring of our ripple effect. We're moving from internal operations to how the bank interacts directly with its clients and manages its loan book. Because really, taking in deposits and extending credit, that is the core engine of a commercial bank.
Our third topic is financial inclusion and capacity building. And the metric here is fascinating. Measuring the number of no-cost retail checking accounts provided to previously unbanked or underbanked customers. From an investor's perspective, this isn't just about corporate charity, not at all. It reveals a bank's ability to capture totally untapped market potential. Emerging financing models allow banks to offer services to previously underserved markets, generating brand new sources of revenue. If a bank can do this responsibly, while avoiding predatory lending, it creates long-term, highly sustainable value.
Which leads us right to the fourth topic, incorporating ESG factors into credit analysis. As financial intermediaries, banks lend to businesses across every industry imaginable. But what if those businesses have hidden environmental or social liabilities? Well, the SASB standard asks banks to describe exactly how they inject these factors directly into the loan approval process. First, they review the borrower's risks. Then, a modern bank takes traditional macroeconomic models and adjusts them based on ESG trends, like climate change or resource constraints. They actually recalculate the probability of default and adjust the value of the posted collateral based on these risks. If a bank isn't doing this, they're essentially taking on hidden risks and pricing their loans completely wrong.
Section 4. Confronting climate risk, the carbon shadow. Zooming out even further, we reach the macroeconomic impact. Here, we are looking at how a bank is inextricably tied to the physical environment through the projects and the companies it chooses to finance.
This brings us to the fifth of our Big Six, financed emissions. I actually like to call this the bank's carbon shadow. By definition, financed emissions are the absolute gross greenhouse gas emissions associated with the bank's loans and investments. So why is this an essential financial disclosure? Well, because a borrower with incredibly high emissions is highly susceptible to rapid technological changes, shifts in supply and demand, and strict new carbon policies. For the bank, that counterparty's environmental risk transforms directly into the bank's credit risk.
Now, what's really interesting here is the level of granular detail the SASB standard demands. Commercial banks can't just throw out a single vague number and call it a day. They have to break down their absolute gross financed emissions by Scope 1, 2, and 3, and then disaggregate that data for each industry and by asset class, like commercial loans versus project finance. They even have to show exactly what percentage of their gross exposure is included in this calculation. This strips away all the mystery and exposes exactly where in the loan portfolio the climate risk lives. It allows an investor to see right away if a bank is dangerously over-indexed in high-risk, high-emission sectors.
Section 5, Preventing Systemic Collapse, the foundation of the financial house. We've now arrived at the final outermost ring of our ripple effect. This is where we examine the bank's relationship with the entire interconnected global economy.
It's a question that literally haunts regulators and investors alike. What happens when a bank gets too big to fail? Because of the extreme interconnectedness of the global financial system, a massive bank failing to manage its risks doesn't just hurt its own shareholders. No, it can contribute to sweeping market disruption and even trigger a global financial crisis.
To monitor this, we have our sixth and final topic, systemic risk management. SASB requires banks to disclose their Global Systemically Important Bank, or GSIB score. This score is calculated using 5 core categories: size, cross-jurisdictional activity, interconnectedness, substitutability, and complexity. The higher the score, the more absolutely critical the bank is to the global system. Banks must disclose this score and describe how they integrate the results of mandatory stress tests into their capital adequacy planning. In simple terms, this tells us if the bank actually has enough cash reserves to absorb a massive shock and stay alive during a full-blown economic meltdown. Section 6, the investor's bottom line, tying it back to cash flow. We have moved from the internal data vault all the way out to global systemic risk. Let's pull this whole thing together and look at the investor's bottom line. Why is this explainer so vital for anyone trying to analyze the true health and value of a commercial bank?
So the crucial point is perfectly summarized right here in the official standard itself. The SASB framework exists to disclose information that is reasonably expected to affect cash flows, access to finance, or the cost of capital. Data breaches, ethical failures, ignoring unbanked markets, blindly lending to high-emission projects, or failing systemic stress tests. These aren't just bad PR. They are direct, measurable threats to a bank's revenue, its loan quality, and its very survival.
I want to leave you with this final thought. We have spent decades defining a safe bank by looking only at its traditional financial statements. But after seeing the power of the Big Six, how data security, financial inclusion, ESG credit models, financed emissions, ethical vaults, and systemic risk management all interlock, how does your definition of a safe investment change? The next time you evaluate a commercial bank, look past the balance sheet, pull up those SASB disclosures, and see what risks are truly lurking in the shadows. Thanks for joining me for this explainer, and keep questioning the numbers.